It is 8:30 a.m. Pacific Daylight Time. It's the 14th day of May 2026, and this is episode 1321 of Bitcoin. And with me, your host, David Bennett, bringing you all the news that you can use about Bitcoin and macro from around the world. And today we're starting with Coinbase and this whole Clarity Crypto Act bill, whatever the hell you want to call it, because that shit's coming up for a vote sometime today on the markup. And there's some amendments that want to be made, and that's going to be the second news story that we get into. And then we're going to hop and skip and jump our way over the pond to where the Bank of England may be backtracking a little bit on their stance on stablecoin. And then, pardon me, good Lord. Claude helped recover $395,000 worth of Bitcoin. I'm not sure if this is going to be the happy story that I want to hear, but we'll do it. Then the second part of the show, Mara sells more Bitcoin, those assholes, and then Nakamoto. Wow, what? I don't know whose brilliant plan. I guess it was David Bailey's, but I guess it was his brilliant plan. But it's just not working out for Nakamoto, or at least not in the way that I think Mr. Bailey thought it was going to work out. And then, while we are going to talk a little bit about the price of Bitcoin, it's going to be connected with this notion that there may be an STRC cycle, a stretch cycle and we're talking about stretch from MicroStrategy. And the last thing in the world that I need on my plate right now is another kind of Bitcoin cycle. I don't want it. But we've got to know about it anyway. And then I keep forgetting that Tether has their own crime unit. And they've got a tally of the number of all the money that they've frozen from would-be criminals. Again, this is sort of the end of the show warning. I like Tether better than I like Circle, but I'm not the biggest fan of what Tether is doing here. And that will be the end of the show warning. So back to Coinbase. Coinbase CEO says crypto bill could rewire American finance. The Senate votes today. Bitcoin magazine Micah Zimmerman. A long-stalled crypto market structure bill is moving through Congress with new momentum. And Coinbase's top executive says it could reshape the American financial system. Coinbase CEO Brian Armstrong declared his company's support for the Digital Asset Market Clarity Act on Wednesday, calling the legislation a true compromise that balances the demands of the crypto industry against the interests of the traditional banking sector, and signaling the bill is in the best shape he has seen since negotiations began. The statements via Fox News came as the Senate Banking Committee prepared to hold its markup of the Clarity Act on May the 14th, the first formal committee vote on the legislation in the Senate after months of procedural delays and 2 canceled markups. Committee Chairman Tim Scott has set a target of June or July of this year for a full Senate vote, while the White House has marked July the 4th as its own goal for a presidential signature. Yay. The Clarity Act, formerly H.R. 3633, the Digital Asset Market Clarity Act of 2025, cleared the House of Representatives July 17th in 2025 in a 294 to 134 bipartisan vote, with all 216 House Republicans in support and 78 Democrats crossing the aisle. And since then, the bill sat in the Senate Banking Committee through 2 canceled markups, extended stablecoin negotiations, and an intensifying lobbying war between crypto firms and Wall Street banks. At its core, the legislation draws a regulatory line between the Securities and Exchange Commission and the Commodity Futures Trading Commission. Under the bill, The CFTC would hold exclusive jurisdiction over spot and cash markets for digital commodities, while the SEC retains authority over investment contract assets and primary market fundraising. Stablecoins are carved out as a separate category under shared oversight. The Senate version of the bill expanded beyond the House text, growing to 9 titles that cover decentralized finance protections, illicit finance provisions, bankruptcy safeguards for crypto customers, and the Blockchain Regulatory Certainty Act, which creates safe harbors for software developers who publish code without controlling customer funds. The bill's most contested provision centered on stablecoin yield. Banks warned that permitting crypto platforms to pay rewards on stablecoin balances would trigger deposit flight from traditional bank accounts and threaten lending operations. Crypto firms, led by Coinbase, argued that restrictions would hand banks a competitive advantage and strip Americans of new financial tools. The standoff produced a compromise brokered by Senators Thom Tillis and Angela Alsobrooks. Under the final language of Section 404 of the bill, stablecoin issuers and affiliated digital asset service providers cannot pay yield on balances if that yield is the functional or economic equivalent of bank interest. Activity-based rewards, however, remain permitted. Those are cashback on payments, transaction-based incentives, and rewards tied to commerce. A stablecoin holder who takes no action generates no return. Armstrong confirmed his support after the compromise text became public, with Coinbase's chief policy officer, Faryar Shirzad, it's a great name, man, declaring the industry secured what is important. Speaking on Fox, Armstrong credited Senators Tillis, Alsobrooks, and their staffs for bringing both sides to the table. Quote, I've got to give a lot of credit to Senators Brooks and Tillis and their staff who worked tirelessly on this, he said. Armstrong described the financial sector as moving fast toward digital asset integration. Quote, I go around, I speak with lots of different bank CEOs, and many of them are just leaning into this as an opportunity to grow into their business. They're integrating stablecoins as fast as they can because, stablecoins. More than 100 crypto firms and industry groups, including the Crypto Council for Innovation and the Blockchain Association, wrote a letter to the Senate Banking Committee in April urging the panel to advance the bill, warning that continued delays risk pushing innovation and capital outside of the United States. Treasury Secretary Scott Bessent reinforced that call. He told the Senate panel that legislation is essential to protecting the dollar's status as the world's reserve currency. The Thursday markup is not the finish line. If the Banking Committee approves the bill, it must merge with a version passed by the Senate Agricultural Committee in a party line 12-11 vote in January of 2026. A full Senate floor vote requires 60 votes, making Democratic support a practical requirement and leaving an ongoing fight over ethics provisions, specifically language addressing President Trump and his family's crypto holdings, as the bill's biggest remaining fault line. That's the end of the article. I disagree with that last. It's section 604 or 602, the one that I was talking about yesterday, where the Fraternal Order of Police saying, no, you can't just write code. If somebody uses it to do something bad or hurt the children or whatever the hell that they want to say, then you've got to be able to hold those developers liable. That's what the FOP is saying. So I honestly believe that, the whole Trump thing, the unforced error of being so steeped in crypto as the president of the United States, whether or not he directly does anything with it or not, his family, that's still a liability when it comes to this kind of shit because it's an ethics issue. He shouldn't have anything to do with this stuff if he wants to be the crypto president. I'm just saying. But I think that's kind of like low on the list. The stablecoin yield stuff is kind of high on the list. But for me, it's really about the developer protections. That's the one. I could give one less about stablecoin yield, and I honestly could care less about the whole Donald Trump thing. The only reason I talk about it is because it's an unforced error. How do you not know you're not going to, whack the hornet's nest with a baseball bat by doing some of the things that he's done? His family is completely connected to crypto. There's no way that you can pass crypto-friendly stuff and not have people like Elizabeth Warren on your ass about it. And say what you want about Elizabeth Warren, the chick's got teeth. She has a bite. I mean, I wish she didn't, but she does. But there are amendments in this markup that are coming, or they're going to try. We'll find out. Sander Lutz from Decrypt writes, Senators file Clarity Act amendments on DeFi, Trump family, and for some reason, Jeffrey Epstein. Whatever, dude. With less than 24 hours to go until the Senate Banking Committee's landmark vote on the Clarity Act, participating senators have introduced dozens of amendments to the major crypto bill. Pausing to say, I've heard as many as 100 amendments. 100. At tomorrow's hearing, which is today, lawmakers will vote on adding each amendment to the sprawling legislation which would formally legalize most crypto activity in the United States before ultimately deciding whether or not to pass the bill onto the Senate floor. Here's a breakdown of those amendments which have been reviewed by Decrypt. The last-minute additions to the Clarity Act pertain not only to well-worn topics like stablecoin and DeFi, but also credit card fees, housing, and even Jeffrey Epstein. Some of today's proposed amendments tackle familiar subjects, including rewards on stablecoin holdings and attempts to limit the lucrative crypto-related ventures of President Donald Trump and his family. One amendment vote sure to garner attention tomorrow, or rather today, comes courtesy of Senator Jack Reed, Democrat of Rhode Island, who has reproduced the exact language on stablecoin yield requested by the banking industry. The amendment will force all members of the Senate Banking Committee to vote on its inclusion in the Clarity Act and essentially pick a side. For months, the banking industry and the crypto lobby have battled over the fate of programs offering rewards on stablecoins, cryptocurrencies pegged to the value of US dollar. The current Clarity Act language on the subject received approval from the crypto industry, but has been hammered by traditional banks. In regards to crypto's potential impact on the broader economy, Senator Tina Smith from Minnesota introduced an amendment that would prohibit the U.S. government from ever providing crypto businesses financial assistance to prevent, quote, failure or bankruptcy. We did that for all the banks. She doesn't want it done for crypto. Another amendment from Senator Elizabeth Warren, here we go, would prevent the U.S. government from approving banking-related applications for institutions directly tied to the president, the vice president, members of Congress, and their immediate families. It would also prohibit such individuals from controlling or owning banks. The language is all but certainly a jab at the Trump family's crypto company, World Liberty Financial, which applied this year to receive a banking charter from the Trump administration. Democrats, including Warren, have hammered the situation as indicative of the president's alleged self-dealing. In a similar vein, Senator Andy Kim, Democrat from New Jersey, has introduced an amendment requiring the reestablishment of an interagency national cryptocurrency enforcement team, which would, among other things, investigate crypto ventures with direct ties to the president and their immediate family. Broader language regarding the president's involvement with crypto is currently being negotiated between leaders in both parties. Key pro-crypto Democrats have said they will not vote the Clarity Act through to the Senate floor tomorrow unless guarantees about such language have been made by the time of the hearing. Of the dozens upon dozens of amendments set to receive votes today, Many pertain to the hot button issues of regulating decentralized finance, protecting user privacy, and maintaining controls on illicit crypto users. Andy Kim, who voted to pass the stablecoin-focused Genius Act out of committee last spring, introduced several amendments to the Clarity Act focused on beefing up national security protections in crypto. One such amendment would require businesses deriving significant revenue from DeFi platforms to institute proactive anti-money laundering and sanctions compliance programs. Another would grant the U.S. government clear jurisdiction to sanction any transactions involving U.S. dollar-backed stablecoins. And then there's another amendment from Elizabeth Warren, and that would allow the U.S. government to blacklist crypto platforms that facilitate more than one illicit transaction. An additional amendment from Jack Reed, this is also going to attract crypto industry's ire, would entirely eliminate the Blockchain Regulatory Certainty Act. That's the BRCA, a key provision of the Clarity Act that exempts DeFi from most new regulations and broadly protecting crypto software developers from criminal prosecution. Let's pause and pontificate on this gentleman, Jack Reed, who wants to make sure that if you write code and somebody else uses it for ill, in their view, that developer no longer has a First Amendment right. And why do I say First Amendment when it comes to code? Because the Ninth Circuit Court of Appeals in the early 1990s basically said code is free speech. It is protected free speech. It's protected by the First Amendment of the Constitution of the United States. And yet Jack Reed does not seem to be aware that the Ninth Circuit Court of Appeals basically said that. I just want to make it very clear that it's unconstitutional. And Jack Reed is somebody who either does not understand the Constitution, does not understand how the court system works when it's protecting the Constitution of the United States, or doesn't care. And I don't need people that don't care about the Constitution having anything to do with leadership of this country. Let's continue. Indeed, advocates such as the DeFi Education Fund. Sorry, I'm laughing. DeFi is a fucking joke. It just is. Maybe one of these days it won't be a joke, but right now it's a fucking joke. So educating somebody about a joke, in my opinion, is kind of humorous. Anyway, advocates such as the DeFi Education Fund have already begun calling out amendments that they want struck down, including those meant to weaken protections for developers and decentralized finance protocols. Senate Republicans have also introduced amendments on the subject of illicit crypto activity and privacy. Bill Hagerty, Republican out of Tennessee, and Dave McCormick, Republican out of Pennsylvania, introduced language that would create a permanent digital asset cyber innovation center at the Treasury Department designed to counter crypto-related threats from state actors including North Korea and Iran. Hagerty also introduced an amendment that would permanently ban the United States government from issuing its own central bank digital currency, or CBDC. A 5-year ban on such an asset is attached to a major housing bill currently on hold in the House. Then there are many amendments that have absolutely nothing to do with cryptocurrency. One, from Bill Hagerty, would cut regulations on housing development in certain areas approved in the country. Another, from Elizabeth Warren, would require federal banking regulators to release all information in their possession related to Jeffrey Epstein and his co-conspirators within 90 days of the Clarity Act's passage. Another one from Warren would cap credit card interest rates at 10% for a year, and one from Senator Katie Britt, a Republican out of Alabama, would increase the swipe fees paid by merchants and retailers to banks to keep up with inflation. Wow, talk about kissing the banking industry's ass. The policy, previously floated by Britt, would be a particular boon to community banks which feel especially threatened by stablecoin yield. Well, learn how to compete, bastards. Quote, if you've made community banks angry about stablecoin yield, this is a nice little treat on the side, one DC insider told Decrypt. Okay. I'm surprised that we even have community banks, and I'm glad that we do. Don't get me wrong. I think community banks are better than massive globalized conglomerates by a long shot. But I'm still surprised that there are as many community banks as there are. And if the way things that have gone in the past continue to go, I don't think the community banks will have much to worry about because I don't think they'll be here. I think there will be more and more small bank failures, and Wells Fargo or Bank of America or JPMorgan Chase will just buy them, which means they're buying their assets and their customer list. And they'll just convert their customers into Wells Fargo customers or whatever. So I'm not all that concerned with the ire that community banks may be having because, like I said, if things keep going the way they're going, community banks are on the way out. And the only thing left that could be considered a community bank will be your local credit union. And I highly recommend, if you have a credit union that you can become a part of in your city or at least in your region, I highly recommend at least checking it out. Just go ask them questions. Call them on the phone. You don't have to go there. Call them on the phone and say, what are you going to give me that my bank doesn't give me? And learn what a credit union can actually do for you. And those credit unions, by the way, are regional and or fairly local. And they kind of function like community banks. And they are going to be a little bit, they've got a lot more protections going for them than straight up community banks do. But there's another bank that we're concerned about, the Bank of England. They have reconsidered strict stablecoin regime. Oh, that didn't take long. Christina Combin out of Cointelegraph. The BOE is reconsidering parts of its proposed regime for pound sterling stablecoins after digital asset companies warned that holding caps and reserve requirements could stifle adoption and make UK-issued tokens uneconomic. The central bank is looking at alternatives to temporary caps on how many stablecoins individuals and businesses can hold, and is examining whether its requirement that at least 40% of backing assets be held as non-interest-bearing deposits at the Bank of England as being overly conservative, Deputy Governor Sarah Breeden told Financial Times. The rethink comes as the UK government and regulators try to position Britain as a competitive hub for digital assets while containing risks to bank funding and financial stability. Pound sterling peg tokens currently make up just a tiny fraction of the $300 billion global stablecoin market, which remains dominated by dollar-based issuers. The BOE set out detailed ownership limits in its November 2025 consultation paper on a proposed regulatory regime for sterling-denominated systemic stablecoins, building on options first aired in the 2023 discussion paper. Under that proposal, individuals would be restricted to holding up to 20,000 pounds sterling, about $27,000 US, of a given UK stablecoin, while businesses would be capped at roughly $13.5 million, at least during the initial transition period. The central bank then argued that limits were needed to avoid a sudden outflow of deposits from commercial banks into new forms of tokenized money if a large stablecoin were rapidly adopted for payments. Industry groups and prospective issuers countered that the caps were operationally cumbersome, hard to supervise across platforms, and could deter serious institutional use of regulated UK stablecoins in areas like corporate treasuries, payroll, settlement. Breeden has been one of the most cautious voices on stablecoin within the Bank of England. In November 2025, she warned that diluting the rules too far could damage financial stability, stressing that stablecoins are money-like instruments that must be at least as safe and robust as existing payments infrastructure. At the time, she backed stringent liquidity requirements that would force stablecoin issuers to park large portions of their reserves at the central bank and hold the rest in high-quality liquid securities such as UK government bonds. Law firms and potential issuers argue that such a structure would significantly compress margins and make UK stablecoin issuance far less attractive than operating under the United States or European Union regimes. The shift in tone highlights how UK policymakers are still feeling their way towards some middle ground on stablecoins as global approaches diverge. In January, UK lawmakers opened an inquiry into how best to oversee fiat-backed tokens, taking evidence from industry participants such as Coinbase and Innovate Finance, while the BOE and Treasury continue to refine a framework intended to sit alongside broader crypto rules and potential digital pound plans. A more flexible approach to caps and backing requirements could determine whether systemic GBP stablecoins, or Great British Pound stablecoins, emerge as serious competitors to dollar-pegged rivals in cross-border payments and onshore crypto markets, or whether activity remains concentrated in jurisdictions seen as, more accommodating. So that's the end of the article. So we've got, it's not exactly an about face, but the Bank of England rethinking what they're rethinking, because having a cap on how much stablecoin you can hold and how you have to back that stablecoin as a bank, those are really onerous restrictions. And the fact that they're rethinking that means that they're rethinking the absolute floor, the base of their entire argument in stifling stablecoin growth in the UK. Again, I'm not rah-rahing for stablecoin. I'm just pointing to the facts. They're not going away, and a lot of people in the world have found utility in using them. I can't stop them from doing that. I can't say a word that is like a magic wand and makes it all go away. This shit's going to happen. And the United States has already dominated the market between Tether and USDC. I'm not sure there's going to be a lot of room left because we were first to the table. And that's going to make a big difference in how the United States moves forward. And I'm here to tell you, man, the empire's not going to fall anytime soon. We all, kind of think that it should, and not because we hate America. It's not America or Americans or American values that we have a problem with. It's the federal government that we've got a problem with. If we could get rid of that and clean that shit up, nobody in the United States would ever say anything bad about America. It sounds like we do, but we're not. We're not talking about that. But the federal government, as the tip of the spear of this particular empire, has been pretty much dirty dealing for, over 100 years. And it kind of needs to stop. But it's not going to stop because now we've got a new way to push debt onto the world's population. And if you've heard this podcast at all before, you know what I think about that. And it makes me want to eat chocolate. It is time for the Circle P. It's where I bring plebs with goods and services just like you to plebs just like you who want to buy those goods and services. But you will be buying in a Bitcoin. Because if you're not selling in a Bitcoin, you're not in the Circle P. And today's vendor is Bitcoin Beans, proof of cacao. Now, I have pulled them out of I haven't pulled them. I've put Bitcoin Beans into rotation today when they should have come like sometime next week because something happened over at the chocolate plantation in Colombia that we need to discuss. This is a Nostr note from Bitcoin Beans, and he says, "Tough day at Bitcoin Beans La Reserva cacao farm. Big storm came in last night and took down a few big trees. which sadly split some of our young cacao trees in half. 4 years worth of hard work wiped out overnight. Sometimes nature feels cruel, but the flip side is more light is coming into the space, which at this stage of the plantation's life is necessary. Every cloud has a silver lining, and it could have been far worse given the size of the trees that came down. Being a farmer is not an easy profession. The amount of energy required to keep the ship afloat is incredible. Every day on the ground, taking care and doing whatever is necessary to co-curate with Mother Earth in the most sustainable and efficient way. This is permaculture. It isn't easy creating a permanent culture. That's what happened. So a big storm tore through his plantation, knocked down some trees, and those trees fell on 4-year-old, 3-year-old, possibly 2-year-old cacao trees. Please consider going to bitcoinbeans.co. That's bitcoinbeans.co. Buy some chocolate. You will not be at all disappointed with this chocolate. It is absolutely the best 100% pure chocolate. There's no sugar. It's just ground cacao, fermented, dried, roasted cacao beans, milled to this beautiful block of, it's a 1 pound block of chocolate. Not only is it beautiful to look at, it is beautiful to eat. Yes, there's no sugar. When there's no sugar in chocolate, that chocolate is food. That chocolate is packed with iron, it's packed with magnesium, it's packed with theobromine. In the chemistry of our bodies, not only do we need macronutrients like proteins and nitrogen, that's where we get our nitrogen from, is from protein. And, like we need phosphorus, we need like sugar, or carbohydrate. We need fiber, right? But chocolate is something different. It carries all kinds of micronutrients like magnesium and a little bit of copper, lots of iron. You need all this stuff. And honestly, chocolate's it's a mood stabilizer. And a lot of people don't really understand that, because in the United States and a lot of the West, the only chocolate that we really get has been mixed with so much sugar that you get, your pancreas is getting, clobbered more than what could possibly be in the chocolate to help stabilize your mood. You're getting a sugar rush, so you don't understand what chocolate can actually do for you. Go to bitcoinbeans.co. That's bitcoinbeans.co. Make sure you use the code Bitcoin and you will get a 5% discount. Remember, these guys, they may have lost some of their cacao trees. They've tried to, heal them. They've strapped them up. But send prayers, send good energy, send positive feelings to our friends at Bitcoin Beans, all right? Because they had a pretty bad night. Now, Claude helps recover $395,000 in Bitcoin that was trapped on a computer for years. Shaura Malwa tells us about this little deal out of CoinDesk, by the way. A viral X post is claiming Claude cracked a forgotten Bitcoin wallet to recover 5 Bitcoin from a user's computer. But don't get caught up in the hype, as that is not what happened. Anthropic's AI simply helped the owners search their own computer for an old wallet file, which was then decrypted with a password the owner already had written down in a notebook. God, talk about luck, pal. User CPRKRN posted the recovery on Wednesday, calling it the most obvious opening ever once they figured out what happened. The owner had been trying for 8 weeks to brute force the password on their current blockchain.com wallet, testing roughly 3.5 trillion combinations using the BTC Recover service on a rented compute chip. The recovery happened when the user, quote, dumped my whole college computer into Claude as a last-ditch effort and the assistant located an old wallet backup from December of 2019 that was encrypted with a password the user already had written down in a notebook. Wow. The old password decrypted the old backup, which contained the same private keys controlling the current funds, since Bitcoin private keys never change. The password itself was LOL 420 fuck the police. per the user's own X disclosure. Total vast.ai GPU spend on the failed brute force attempts was around $15, with the recovery effectively a file search. For context, breaking Bitcoin's actual cryptography would require either a working quantum computer running Shor's algorithm or a flaw in elliptic curve cryptography that has not been found in 16 years of public scrutiny. CoinDesk's post-quantum security series earlier this year covered the timeline expectations for that threat. But the user's experience opens up a further door for AI inside crypto. Forgotten wallets from Bitcoin's early years now hold serious value, and recovery tools like BTC Recover have existed for years to help users test password variations against encrypted wallet files. The problem has always been that most recovery work requires technical expertise that the average lost Bitcoiner just doesn't have. That is where AI assistants can step in. Instead of manually sorting through folders, timestamps, and backup files across years of accumulated drive clutter, owners can hand the search to an LLM and have it identify patterns, narrow the search space, and surface candidate files. Millions of Bitcoin are believed to remain inaccessible because owners lost passwords, drives, or recovery phases during the early years. Wow. So so AI did not brute force the wallet. It just found a wallet file. And if you've got a hard drive that is, or several hard drives that are as packed with files as mine, yeah, I kind of appreciate this. Let's run the numbers. CNBC futures and commodities. Brent North Sea oil down 0.7% to $104.82 a barrel. West Texas Intermediate down a quarter to $100.79. Natural gas is the hedge today, 0.8% to the upside, clocking $2.88 per thousand, and gasoline down over 1.5 to $3.55 a gallon, while Murban crude is up almost a point to $104.59. Metals are all down today. Palladium is down the worst, I think, almost 5 full points. Gold is down 0.5 to $46.83 and 9 dimes. Platinum is down 5 1/3. Wow, holy shit, there's the winner. Silver is down 4.5 to $85 and 3 dimes, and copper is down 1.12%. By the way, copper at, I think it's $6.60 a pound. That price is screaming. I looked at like the data of what the graph of copper since 1990. Dude, it is shooting to the freaking moon, and it's all being driven by all these data centers, and they need wire, and the best wire comes out of copper. All right, it just does. So more and more copper is going to be called for as these data centers continue to be constructed. So we may not end, and probably will not end, at copper being $6.60 a pound. Holy smokes. Ag is mostly in the red today. Biggest winner is lumber, 0.35 to the upside. Biggest loser is chocolate, 3.89% to the downside. Live cattle is up 0.8%. Lean hogs down over a point, and feeder cattle up 3/4 of a point. S&P just clocked an all-time high after rising almost a full point this morning. NASDAQ is up a full point. The Dow is up almost a full point. And the S&P Mini is up 3/4 of a point. And then there's Bitcoin, which is $81,440. That's now back to a $1.63 trillion market cap. Excuse me. We can purchase 17.4 ounces of our favorite shiny metal rocks with our one Bitcoin, of which there are 20,029,107.4 of. And average fees per block are normal. There are, in fact, about 42 blocks carrying 79,000 unconfirmed transactions. Waiting to clear at high priority rates of 1 sat per VByte. Low priority will get you in at 0.3. 997 exahashes per second is the hash rate on the Bitcoin network. Really close to coming back across that into that zettahash territory. And from yesterday's episode, Clarity under attack. I've got, if it'll come back up, Oak Grove with 10,000 sats. Thank you, my friend. He says, great news. The Fort Bitcoin meetup is going to be at a bomb-ass place in the stockyards. I'll buy you a drink when you get here. And, by the way, let's see if this will resolve to a URL I can read. It does not. I am going to put this URL into the show notes today. In fact, I want to do that right now so that if you want to go to this meetup, you will be able to go to the meetup, and I'm putting it in right now so that I don't forget. So let's get back to the thing. Oak Grove says that Fort Bitcoin meetup is going to be a bomb-ass place in the stockyards, and he's going to buy you a drink. So click the link in the show notes. It'll say meetup in all caps right below the Circle P stuff. So click that link. Buy yourself a ticket and get over there. Paul Surnine with 1,000 says, haven't been listening much recently due to travels, but trying to catch up now. Good to hear you're going strong in spite of market conditions and keeping the torch burning. High time to boost you again. And Paul, I certainly appreciate it. It is hard to, come here day in and day out and give you guys the news. It's easy to do it when Bitcoin is screaming. When everything seems fine. It's really hard to do it when you're in a bear market. And I've done this show through at least 2, if not 3. This will be, I think, my third. Yeah, this will be my third bear on doing this show. And the bears are longer than the bulls. So it takes a lot of energy to get behind the mic and produce this show for you every single day. So boost kindly, please. Jason High with 250 says boost. Nick Dose with 212 says cheers. To be discussed with 210 says you are appreciated. Thank you. Permanerd with 210 says somebody give this man an editor job. Yeah, no shit. And Cycros with 100 says the thing about saying tokenized stock, futures, etc. are void is I never expected tokenized stock to actually mean you own the stock like a shareholder does. Rather, that you have an IOU that tracks the stock one-to-one on the balance sheet of whoever tokenized it. Essentially, and it goes to ... because Fountain has capped the number of characters that I can read even though I'm on a desktop. Cycros, I am sorry that I was not able to finish your note. I might just have to start using Helipad off of my Start9 router. Because I can track it better, I guess. But I've had a problem with Helipad too. Some people give me notes that I can see on Fountain that I can't see on Helipad for some reason, and I don't know why. But for whatever reason, boost and boost kindly, and that's the weather report. Welcome to part 2 of the news that you can use. Mara sells almost 21,000 Bitcoin for 1.5 billion. This is out of Atlas 21. The contradiction is now plain to see within the Bitcoin treasury ecosystem itself. Mara Holdings sold 21,000 Bitcoin worth 1.5 billion in the first quarter of 2026, as revealed by financial results published on May the 12th. The move came as JPMorgan declared that Bitcoin was gaining ground at gold's expense, fueling the so-called debasement trade. At the same time, Bitcoin climbed roughly 30% over the past 2 months, rising from a low of around $62,000. It is now $80,621 by May the 12th, and Mara's quarterly results paint a clear picture. The company used $1 billion of the proceeds to repay roughly 30% of its convertible debt, reducing obligations from $3.3 to $2.3 billion. Mara reported a net loss of $1.26 billion and dropped from second to fourth place among public companies ranked by BTC Holdings. CFO Salman Khan stated during the analyst call, quote, Bitcoin is not just a reserve asset on our balance sheet. It is also a source of strategic financial flexibility. The proceeds from the sale are funding the largest acquisition in Mara's history, a $1.5 billion deal for the Long Ridge Energy and Power Campus in Ohio, which includes a 505 megawatt gas-fired power plant and 1,600 acres earmarked for artificial intelligence data center development. The company plans to allocate up to 90% of its mining capacity to AI workloads. This development fits into a broader trend of publicly listed miners collectively selling more than 32,000 Bitcoin in the first quarter of 2026, exceeding the total miner sales for all of 2025. On the opposite side stands analysts at JPMorgan, led by Nicholas, can't pronounce this guy's last name, who note that spot Bitcoin ETFs recorded inflows for 3 consecutive months through May, while gold ETFs are still struggling to recover from the outflows that followed the Iran conflict in March. The bank argues that, quote, Bitcoin is rising at gold's expense, end quote. Adding weight to the broader thesis is Ray Dalio, who in a Forbes interview stated, quote, looking at history, we see that in all these periods, all fiat currencies decline and gold rises. I don't think any of the fiat currencies will be an effective store of value, end quote. And the backdrop to that interview was a federal debt surpassing $39 trillion. Let's move on to Nakamoto. Oh boy. Bitcoin firm Nakamoto's stock hits a new low after posting a $239 million loss, and it sold more of its Bitcoin. Logan Hitchcock giving us the lowdown on what's going on with Nakamoto. The medical firm turned Bitcoin treasury reached a new all-time low on Thursday after the company reported a net loss of nearly $239 million in the first quarter thanks to the decline in Bitcoin prices. Naka fell more than 4% after the opening bell on Thursday, setting a new 52-week low of 16 pennies before moving slightly higher to recently change hands at 16.6 United States pennies. At that mark, the firm's share prices are now down more than 99.5% from its 52-week high of $34.77 per share. Oh, God. Quote, the first quarter marked a transformational period for Nakamoto as we formally transitioned into a Bitcoin operating company, said Nakamoto CEO David Bailey in a statement. Quote, our focus for the remainder of 2026 is execution, scaling our operating business, expanding revenue opportunities, and continuing to build durable shareholder value through disciplined capital allocation and long-term conviction in Bitcoin. Durable shareholder value and a loss of 99.5% of your share price in the same sentence doesn't really work, does it? But revenues in this quarter stood at around 2.7 million, with around 41% or 1.1 million worth coming from an actively managed derivative strategy. Quote, Bitcoin isn't just sitting idle on our balance sheet. We believe it can be managed strategically. Strategery. Yeah, okay. Its active treasury management includes sales of Bitcoin holdings, with the firm selling off 284 Bitcoin, about $22 million worth of the top cryptocurrency, surpassing its quarter 4 sales of around 20 million. Good Lord. The firm's sales were, quote, to support working capital requirements. It additionally sold 4 Bitcoin worth about $3.2 million that it earned as income from premiums. So as it stands, Nakamoto still maintains a Bitcoin treasury of more than 5,000 Bitcoin, or about $400 million worth. Okay, so the number that worries me the most here is the $2.7 million in revenue. Now, if you remember, Nakamoto is David Bailey's outfit, and David Bailey was the leader and still is kind of Bitcoin Magazine and the Bitcoin Conference, which is the largest Bitcoin conference in the world. And there's actually multiple of them. It's not just the big one in the United States. They're making more, okay? And it's one of the most well-attended conferences that there is. I think one year it had like 30,000 people go. How the hell do you have that and only generate a revenue of $2.7 million along with all the rest of your stuff? I don't know, man. I think this whole Nakamoto thing was David Bailey looking at everybody else jumping onto the Bitcoin treasury train, and he got on the last car, and it doesn't seem like that car was bolted onto the train very well. It's really frustrating to see this shit happen, especially by people who I would think would know better. It is what it is. But Bitcoin's dip below 80,000 could be short-lived as STRC cycle looms. This is Akash Giramith out of Decrypt. And the reason I'm reading you this one, because I don't normally try to talk about Bitcoin prices and chartalists and whatever, but it's this notion of a STRC cycle that I want to get into. The leading cryptocurrency is trading at around 79,680, blah, blah, blah. That's the price stuff. It gives into the price stuff. And then here we go. The dip will be short-lived. Andrei Falzin-Adzima, researcher lead at BitTrue Research Institute, told Decrypt, quote, "We've seen a classic liquidity sweep of recent lows around 78 to 79K, followed by a solid defense of the monthly 50-day moving average and a quick reclaim above 80K. On-chart flows show large wallets continuing to accumulate aggressively. However, there's another factor working behind the scenes. Bitcoin treasury firm Strategy's preferred shares STRC pronounced stretch. Strategy's stretch has fueled mid-month rallies for 3 consecutive months, according to a Tuesday report from K33 Research. The Bitcoin treasury company has ramped up its Bitcoin purchases through this instrument from 4,467 Bitcoin in January to 22,131 Bitcoin in March, and nearly 46,872 Bitcoin in April. Holy shit. Quote, "This Friday marks another STRC ex-dividend date, which could spark another mid-month rally soon." And that's according to Vettel Lund, the firm's head of research. The mechanism works like this. STRC pays dividends on the last day of each month, with ownership determined by the ex-dividend date on the 15th of that month. Investors pile in ahead of the dividend, pushing the stock towards its $100 par value, which allows Strategy to issue additional shares and use the proceeds to buy Bitcoin. However, Adzima cautioned that the May cycle already looks different. Quote, "Stretch recovered to par much more slowly, and the actual conversion into Bitcoin buying has been minimal so far, only around 1 BTC reported through the instrument," he said. Quote, "Demand for the preferred seems to be plateauing after the big earlier runs. The mechanism is still there, but it lacks the scale and urgency we saw in March and April," end quote. Bitcoin has not kept pace with the AI-driven equity rally, according to Jeff Koh, analyst at CoinEx. Quote, "The old AI rally lifts crypto thesis is broken. If anything, the AI rally is now absorbing the speculative capital that used to flow into crypto," end quote. And he's probably not wrong. Still, Koh sees constructive signs, with Bitcoin ETFs drawing in over $4 billion in inflow since March and stablecoins absorbing more than $7 billion since February. Quote, "Crypto will gradually leave the bearish zone from here if ETF and stablecoin flows hold up." And then they go and talk about the Clarity Act markup hearings, which we've already done. So it's this notion of the stretch cycle. And this gentleman named Co is already saying that this particular cycle this month looks different. So yeah, if the dividend pays at the end of the month, but you have to be registered as a bona fide holder of Stretch preferred stock by the 15th of that month to get that dividend, then yes, you're going to, if you want the dividend, and a lot of people want 11.5% is what this dividend is. If you want that, then the only way to demonstrate that is that you got to buy shares of Stretch. And as you buy shares of Stretch, the par value of that stock actually goes up to where it should be, right around $100. But then you get your dividend. Or, and here's the other, well, here's my question. If you're a holder by the 15th, can you sell your stock on the 16th and still get the dividend? That one, I don't know. If somebody out there is more savvy about this kind of shit than I am, please let me know. Otherwise, I'm going to make an assumption that you've got to hold it at least all the way until you actually get the dividend, and then you can just punch out. Unless you can punch out on the day after the date of record, which would be the mid-month, the 15th. And in so doing, and I guess I could go back and look at the charts and like start looking at the 16th of every month and see if I can see a dip. And if I did, I would presume that people are just, hey, as long as I'm on record by the 15th, I'm going to get my dividend. I can sell the day after that I'm, the date of record, and that would bring the par value back down. Like I said, I don't care that much about Stretch. What I care about is that in all the world, and I'm talking about the physical world that you live in, all energies are based on a sine wave. Energy itself, whether it's electricity or radio waves or ultraviolet or any color of the rainbow, light, all the heat, even infrared heat, operates at a frequency. Everything does. Everything does. If you were to boil it down to subatomic particles, you're going to see the same shit. Everything that you see is energy. Doesn't mean that you're going to be able to, put your head through a wall without, it hurting a lot. But still, that wall and your head, 100% pure energy. Mass is nothing but energy. And as we have grown up, as we have evolved on this planet, in this universe as beings, it's not outside the realm of possibility that even if we didn't know that all these things are on cycles, that somehow or another we collapse ourselves into operating on cycles, whether it's like your weekly workout routine, or when you buy Stretch to get the dividend and when you sell it, or the 4-year cycle of Bitcoin that we've had ever since Bitcoin has begun. And when cycles start to compound on each other, because it used to be just the 4-year cycle of Bitcoin, but now we've got somebody like Saylor in the mix, and now he's got a different kind of cycle that is embedded inside the cycle of the 4-year cycle. So now you've got potential harmony, or you've got potential dissonance. And I don't want to get too far into it, but as more cycles start to come into the 4-year Bitcoin cycle, there could be beautiful music made, or it could be a horrendous noise. Again, and I hate saying it, we'll have to see. Meanwhile, Tether's T3 crime unit says that it's frozen $450 million worth of suspected illicit crypto. This is Christina Comben bringing us to the end of the show with Cointelegraph. The T3 financial crime unit, a joint initiative backed by Tether, Tron, and blockchain analytics company TRM Labs, says that it has helped freeze more than $450 million in assets linked to suspected criminal activity since its launch in 2024. The group said in a Thursday release shared with Cointelegraph that it has worked with law enforcement agencies across 23 jurisdictions to target funds tied to alleged drug trafficking, exchange hacks, North Korea-linked activity, terrorist financing, and violent wrench attacks, including kidnappings and extortion. The unit focuses on Tether's USDT stablecoin activity on the Tron blockchain and says it has been able to freeze assets within 24 hours in multiple emergency cases at the request of authorities. T3FCU said it intercepted 43.9% more illicit proceeds in 2025 than in the previous year. The announcement comes as TRM Labs estimates that overall illicit crypto flows reached a record $158 billion in 2025, according to the release, highlighting the growing pressure on stablecoin issuers and blockchain networks to strengthen compliance and cooperate more closely with law enforcement. So for any of you that think that I am a cheerleader for Tether, I am not. And there's two reasons. One, stable coins that are linked to the US dollar are also inflationary, and the whole point of Bitcoin was to stop that shit. Stable coins are not Bitcoin. They are not an investment vehicle. It will be inflated away as the US dollar that backs it is also inflated away. Number two, they can freeze your shit. Also, what Bitcoin was expressly designed to stop happening. So, I'm not a fan of Tether. I'm certainly not a fan of USDC or the guy over at Circle, Jeremy Allaire, because of the two people that hold the reins of these companies, which is Paolo Ardoino and Jeremy Allaire. Only Jeremy Allaire signed his name to the New York agreement that was set to destroy Bitcoin. He wanted to destroy Bitcoin. He signed his name to a document that tried to destroy Bitcoin. Paolo Ardoino did not. Out of the two stablecoin companies in the United States, if I've got to pick one, gun to head, I'm picking Tether. Because at least that dude had his shit straight and didn't sign his name to a piece of paper that tried to fuck Bitcoin. I'll see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.